Dear students, we should make a contract. When do you want to begin with your class? Because if you all come late, I also come late. I don't mind, it's your choice. But in Germany, yeah, we usually begin right in the right minute. Yeah? Maybe 1 minute later, but not 12 minutes later. So actually we should ask the people who are not in the room right now. Yeah, but it's really up to you. Right? You can say, let's start at 9:10 or at 9:05 or at 9:15. What would you prefer? Any
Just start
suggestions?
on time. We will try our best to be on time, tomorrow onwards. So just start sharp at 9.
Yeah. Yeah, but maybe if you come to the bus and that's a bit late and then somebody can't make it at 9 o'clock. Is it just a matter of discipline that you try hard? For me, of course, it's easier. I just have 2 minutes of walking time. So, yeah, let's try to start, because I think it does make sense to start the lecture when only half of the class is there. Okay, so let's continue where we stopped, and then after this presentation we go on with the time case, and then we start with the M&A slides. And you get a more introduction to this. Yeah, so this was just an easy example on how to prepare a DCF model that looks on the surface quite professional, but indeed is very simple inside. And the nice thing with this is it is only a few parameters that really drive the model. Because if you are an investment banker and you have prepared a complex model, you will be asked, how did you do this? Your boss in the investment bank will want to know whether it makes sense and what kind of assumptions you made. So whatever you plan, you should really try to do only a few assumptions that you can discuss with your boss and that are easy to describe. And then of course the boss will find it easy to become familiar with your model. And of course, and if you think, how do I choose these parameters? Of course, you can look into the past. You can look at comparable companies, how they do. If you see, for example, that the profit margin of the company that you are analyzing is below industry's average, you can assume it will increase towards the industry average, and then this is an assumption. You found industry average to be 10%. History was 5%, and then you have a value increase from 5% to 10% for the interest margin. That is an easy to understand assumption, and your boss will say, yeah, I agree or I disagree, and this. When you think about CapEx, there is one more thing, this V. You can basically say the amount of machines must correspond to the number of cars, basically, that you produce, to the amount of production. But of course, it is more precise to say, if I want to increase my revenues, then I need CapEx. And if machines are destroyed by depreciation, I have to replace them. So an easy and straightforward guess is that depreciation really measures machines that are no longer usable, and I have to replace them, and revenue growth is financed this way. But then again, you have to think about what is a sensible measure for D, and you can basically again look at the past and look at the comparable firms to do this. And then with zero growth, that is quite often a company like Continental basically has reached almost a steady equilibrium. There was probably no growth, and then CapEx equal to depreciation simply means that you just replace the rotten machines. But then again, some people argue that depreciation is more than the real destruction of value. Machines, even if they have a zero value after depreciation, quite often continue to function, and maybe you don't have to invest. So that is really up to you to think about this. As a private equity firm, of course, this is where a lot of the value comes from. If you can reduce the CapEx, the company planned quite aggressively, but you basically think the old machines will continue to work, and you can easily increase the discounted cash flow value, by having more aggressive assumptions here. But then of course you need to have some experience when this actually works. Maybe the production breaks down and you can no longer produce whatever you produce. So when you do these estimations, I think it's important to look at the industry, and you always compare the firm that you want to value with other firms. Good morning. Look at the ratios of these other firms, and basically look whether there is a trend, whether the ratios are increasing or decreasing. You should always look at what analysts forecast. As an investment banker, and then you will have access to this. Basically, analysts write long reports, sometimes 10, 20 pages, with lots of additional insights on the company. Of course, you read all the company reports, but this is 200-page long, the financial statement. And then the question is, how do I read this? My recommendation, always use ChatGPT, because if you upload the financial report, ask a question, hopefully, or better, it is better with Perplexity, because Perplexity basically gives you the part of the document. If you just use Google, and then look for something like EBITDA, EBITDA is mentioned on 20 different pages. It should be time consuming. You must find a way to efficiently read the documents and find the information that you need. When you use management forecasts, of course, remember they are likely to be biased. Management is notoriously optimistic. Brokers or analysts, of course, are less optimistic, but still they are sometimes accused of being too optimistic. You always compare to industry averages, in particular when the firm is in a special situation, it's in a stress crisis situation, then of course you usually assume a return to some averages. And of course, if you have a cyclical business that is going up and down with the business cycle, then depending on where we are right now, in a boom or in a recession, you should also account for this in your estimation. So that's basically what analysts are doing. And then once you have all the information, of course, all is to basically find the discounted value. And for the first 5 or 10 years, you usually have a detailed plan, and after 10 years, then you usually use a terminal value. On the slides of the textbook, we have only the Gordon growth model, and then everything that you have to do is to choose G. On the entry slides of Citigroup, they also use this model, but one very popular alternative model is the exit multiple. If you are a private equity fund, basically you think that you buy the firm for a particular multiple, you pay, for example, 10 times EBITDA, and then private equity firms quite often assume that you also exit the firm at 10 times EBITDA. So you try to make money by improving the firm, by increasing the free cash flow, but just in order to be conservative, quite often you assume that entry and exit multiple is the same, or you basically say, I know an average multiple paid in the industry, and that is basically my estimate. Practitioners from the PE industry basically are more familiar with this kind of thing. When you ask them for the growth rate, they say, I don't know. But if you ask them for an exit multiple, they immediately say, in that industry, it is reasonable to assume a multiple of 10 or 7 or whatsoever. And then of course the firm value is given by the simple formula from the textbook. But here it's a recap, but for you this is basically prevision. In a later chapter we will see there is this other model called APV. And just to explain you, in the so-called APV or what's called LBL model, the tax benefits are included in the cash flow forecasts. And here in the WACC approach, the cash flow forecasts assume all equity firm. So you assume wrong taxes, taxes that never ever will be paid in reality, but very simple. You pay full taxes on EBIT. And then you incorporate the tax benefit in the WACC by having this 1 minus t here. In the APV model, this 1 minus t is not there. You use the so-called unlevered cost of capital, and the tax benefits are in the nominator in the cash flow statement. Both models work, and the APV model is also called LBO model because in an LBO case, for some reasons that we don't discuss here, this model makes a bit more sense. It gives you a bit more information, but the WACC model is simply simpler to apply, and therefore probably your preferred choice. And in order to see the textbook theory behind it, the value of a leveraged firm is the value of an unleveraged firm in perfect markets, when we have no taxes, when we have no market imperfections, under Modigliani-Miller assumptions. Next week we will see a very easy example from the textbook of why this is so. But the idea is simply the firm is like a cake or an apple tree, and debt and equity simply determine who gets how many of the apples. In the end, the apples are the cash flows. They flow to the capital market, and they may flow either as a coupon payment to the bondholders or as a dividend to the equity holders. But all apples will somehow be distributed. But with a tax shield, of course, there is an extra benefit from using debt, and that has a present value. In the APV model, you basically model this separately. And you can see this is the value of my assets, and here comes on top the value of the tax shield, and this gives them the value of the leverage firm. In the WACC approach, it is basically jointly estimated. You just got to get one value, and it implicitly comes from both sources. But then, of course, there are many other things. Like if you have too much debt, you run a high probability of bankruptcy, and bankruptcy has its own cost. And next week we will see other things, like incentive problems and all kinds of other things that also play a role here. The optimal choice of leverage is a complex kind of thing, and the many other pros and cons are simply completely ignored in valuation. When you do a valuation, that you do, please just try out on the spreadsheet to increase the leverage ratio, and you will find the firm value must also go up. Simply because only the benefits of leverage are modeled here. There are more tax benefits, but the negative side, like increased bankruptcy costs, is simply not modeled in the spreadsheet. So these spreadsheets are a bit biased towards debt. If you are an investment banker, you can easily basically produce higher values simply by being more aggressive with the debt structure. But then if you propose too much debt, then people will ask you, is that actually reasonable? Is it doable? Will banks provide the debt at normal rates? And this basically puts it up a little bit to it. When you calculate of course, in the WACC function, you need to put in the value of equity. These ratios E over E plus V can be either book values or market values. Book values is what you see in the balance sheet statement. There is equity and debt separately shown, and this gives you the book equity ratio. The market value would be the so-called market capitalization. Equity is then the number of shares times the share price. In the valuation, which is the number of shares times the value of the share that you find from this valuation. From a theoretical point of view, we all talk about values here. Accounting is not the profession of financial people. Financial people basically think that all these theories are made on economic terms and not on accounting terms. So the first basically mistake is to just plug in accounting ratios, although many practitioners do so. Many practitioners simply don't think about this. Of course, for Continental, your company, you have a stock price. So you can easily put in the market value of the equity. Yeah? But to be 100% consistent with theory, you should put the result of your the market value of the equity is the result of the overall calculation. At the end, you find an implied share price, and you put, and you should be consistent in having the same the resulting share price also as an input. You basically say if the share price measured by this in this E is maybe 10, then I calculate the firm and find a share price of 8. But that doesn't make sense. You assume it is 10 and then find it as 8. So there is a circularity problem, basically 2 equations, 2 unknowns, and the easiest way to get around there is basically try and try and change. So if the initial guess is too low, just increase it a little bit until it is consistent. Most practitioners actually don't care about this at all, because they are not aware of this. They just plug in any kind of ratio and are happy with this. And in the end, as you saw with Citigroup, if you don't even know what the right rank is, you basically say this is only guesswork. Some people will say it is a bit higher, some people say it's a bit lower. And then of course you don't care about the precision and the logical coherence of this little problem. Many practitioners say, no, the thing is different. This is the future target ratio. In particular, when I take the company over and I plan to change the capital structure, then of course the valuation must be based on my plans for the future. So this is a nice way to circumvent the circularity problem. I simply assume what I see in the past is past, and in the future I believe that Continental should have a target capital structure of X, Y, Z, and that's what I put in. But again, when you value Continental as it is today, of course you have to also recognize the capital structure choices that they have done so. And as long as there was no new management, no takeover, why would you assume that they would change anything? Continental, as you buy it today in the market, has a particular capital structure, has a particular strategy in terms of capital structure, and usually you should take this as a valuation. And then if you are a private equity firm and then plan, for example, to increase this, then you have to look on many things. For example, covenants are basically restrictions. If you want to have high levels of debt, the banks basically will want to add some security and basically say, that is okay. You want, for example, only 20%, but when it's go to below 15%, then the whole debt has to be repaid immediately. So I allow you to use high leverage, but whenever the leverage increases above a certain level, basically you lost everything. You have to hand over the firm to the bank. That is the typical covenant restriction, and these restrictions, of course, are not very popular with the private equity firm, with the owner. And then they have to think about what is the optimal. It's a science by itself. And for practitioners, of course, have a good understanding of what is the maximum debt level for particular industries. A firm like Continental have lots of assets. These assets are collateral for the bank, and even in the worst case, you can sell the machines. And if you think about a company like Microsoft, there were no assets. If Microsoft should go bankrupt, there was nothing left over for the bank. So no surprise that Continental can easily achieve higher debt levels than Microsoft.
Sorry, Professor, just curious, what if a corporation has several lenders, then on that condition, then who will actually...
that's interesting. In practice, of course, there are many lenders, different banks, different other things, a bond issued in the bond market. In an LBO situation, of course, they all sit at one table. And usually you have a consortium of banks that have only one contract. And the contract basically, and this is because, well, just one example. Suppose that you do the contract that D must be smaller than some maximum. Initially, you say, okay, you get 100 of them. And 1 month afterwards, the company goes to the market and issues new debt. Then of course the old debt becomes more risky. And you can prevent this in contracts. You basically say it is forbidden to issue new debt afterwards. That is quite often the covenant restriction. Or you plan everything at once at the beginning. So usually you have everything basically fixed in a rather complex contractual arrangement. Because increasing the debt afterwards is clearly a thing that banks don't like. And therefore they need protection and they secure protection. By the way, something like reputation also makes a big impact. There are acquirers that are simply well known. Toyota, for example, when they take over something, this is a family, very conservative, they never risk bankruptcy, and that is a good sign. If this is a very aggressive private equity fund, and they have created lots of bankruptcies in their portfolio already, then of course the markets are much more risk averse and basically restrict the use of debt. And then basically applying the capital asset pricing model in order to estimate the cost of equity. You know this, and you saw it on the textbook slides already on what to do. Practitioners quite often add something. If this is a small firm or if this is a private firm, then if this is an illiquid firm, they sometimes basically just say these firms are trading at a discount, and the discount is reflected in an additional requirement. And of course, you can try to look for empirical evidence on this. There is always a paper that writes about this, and then you basically say, the paper found 1%, and I recognize this. You saw already that we had this, the beta estimation from the CAPM, this kind of regression in order to estimate beta. When you look for the beta of Continental, you basically look it up on Bloomberg, or you look it up on the internet, and you will find sometimes 2 or 3 different betas. And then the question is, which one do you take? Or if you want to do the regression yourself, there were at least a number of questions. Do you use daily, weekly, or monthly returns? Do you use 5 years or 10 years of data? So even if you estimate yourself, you will have choices to do. And of course, there is no correct or wrong. There are some industry standards. Better use monthly data or at least weekly data and not daily data. The time frame actually is dictated by the stability of the environment. If you say Continental 5 years ago was like Continental today in terms of its risk exposure, then you may say, okay, 5 years makes sense. But suppose Continental 5 years ago was really a different firm, because they have been divesting something, and therefore the assets and the risk profile has been changing, and then of course you would use a smaller sample of data in order to estimate this. Data is on Bloomberg, but also on Finance Yahoo. You find all the data. And basically, if you like, please try out. Just do the prompt. I need to estimate the beta. Dear ChatGPT, write the Python code. Download the data from Yahoo Finance or from wherever. Show me the regression estimate. Try to do it. And then you can ask ChatGPT, do it with weekly or monthly data, do it with 5 years or 10 years of data, and ChatGPT can do almost everything. They write the Python code, they download the data, they run the regression for you, and you just directly get the results. So with the help of modern technology, you are much faster in really doing your own analysis. Yeah? And if this would be a graded exercise, yeah, of course students that do their own estimation are quite often graded a bit better than others, yeah, but we don't take this too seriously. Yeah? Don't feel under pressure. Yeah? This is basically for you to learn and not for you to obtain good grades. Yeah? But if you, this is a good opportunity to see how ChatGPT can really write Python code, retrieve data from the internet, run the regression, yeah, and present the regression in an easy way to you. And you can simply ask, I don't understand the regression output results. Yeah, please explain, yeah, what this number actually means. And I still find it fascinating how well this works. Yeah, of course, ChatGPT is not always correct, yeah, but in these kinds of things, there is no hallucination, yeah, simply because all the textbooks and all the computer codes basically apply the correct thing. Yeah, so you will almost always find a good answer. Yeah, if you value private firms, then of course you use the beta of public firms in order to start with. Yeah, and then you have to adjust at least the capital structure. Yeah, and then you basically first unlever and then relever. Yeah, so you have estimated the beta for a public firm like Continental, but you want to value a similar company, whatever its name is, yeah, and it has similar assets but a different capital structure. Yeah. Then basically by unlevering this is then the Continental beta that you estimate on the market. This would be if these assets are unlevered. Yeah. And if you put in here your private firm capital structure, and then you have the implied equity beta of your private firm with one particular equity structure. Yeah? So just use the same formula just by solving it for different things. Yeah? This is twice the same formula, yeah? Just solve for beta E and for beta U. Yeah? And this is basically done over and over, yeah, in investment banking, just to make two different firms better comparable. Yeah. Also, my historical leverage is different from future leverage. Yeah. You intend to buy Continental, yeah, but you saw in the past it had almost no debt or very low debt. In the future, you wanted it to have more debt. Yeah. And you know, of course, that the risk of the equity will increase. Yeah. Then you first measure the historical equity beta. Yeah, unlever it, and then relever it with your new capital structure. Yeah, and this will then be the new beta based on the future planned capital structure. Yeah, and it will likely to be bigger if you plan to use more debt in the future. Yeah, and just by the way, this is, I think, this comes from an academic paper, but you can simply also ask ChatGPT, yeah, do you know different formulas to lever and unlever beta? Yeah, and it's just surprising that there are many different models. Yeah, so we use this here in our class, yeah, but many textbooks use this beta without the tax. Basically in a world where there are no taxes, yeah, this is the right formula, and then basically you can do all kinds of different assumptions and basically have different formulas. Yeah? And the sometimes surprising thing in finance is, yeah, different people use different models, different formulas, and in order to see which formula is correct or not correct, all these formulas are correct. Yeah? It's just based on different assumptions, different models. So we apply sometimes models where we are not really sure what the assumptions are. Ideally, of course, you should understand all the differences in the assumptions and be aware of them. But honestly, almost no finance student of the world knows the difference between these models and simply assume that applies one of these formulas and full stop. Yeah, and as in our textbook, the cost of debt is of course, what the capital market requires. In particular, if you plan like a private equity fund, yeah, you increase the leverage, yeah, now of course the debt has become more risky, and you ask yourself what would be the required return that the debt holders now require. Yeah? And they will require a credit spread over the risk-free rate, and the credit spread, of course, is a compensation for bankruptcy risk. Yeah? And the bankruptcy risk depends on the leverage and on the riskiness of the assets. The credit spread mainly depends on the credit rating. And if you analyze Continental, yeah, I would first Google for the credit rating. Yeah, what is the rating class of Continental? And then the second thing that an investment banker would do is to see what is the spread that Continental currently pays. How does it compare to the average spread that other companies with a similar rating pay? Yeah, so is Continental in a special situation currently? Yeah, and then you basically, if you plan for a different rating class, your plan is to increase the leverage, yeah, then basically you would say, okay, the rating will deteriorate to maybe BB, yeah, and then you look at an average spread for BB rated companies, yeah, and that would be the new cost of loans.
So, Professor, for credit rating, usually which one would we choose among, like Moody or Fitch or?
It doesn't matter at all. Well, for market practitioners, there were 3 recognized rating companies, yeah, and that is Fitch, Moody's, and Standard & Poor's. And basically, there were translation tables. Yeah? And AA at Moody's means large A's to small A's at Standard & Poor's. Yeah? And basically, they all are the same. Yeah? They all have 18 different classes, yeah? And there was a direct translation table. And then, of course, there were other credit rating agencies that are not well known, yeah? In particular the smaller national ones, but as an investor you would usually not use them. Yeah? They are simply too unreliable. Quite often in countries like, it's both in Germany and also in Vietnam, yeah? People want to produce a credit rating, yeah? But they don't have the money to pay the recognized American ones, yeah? And then they just pay a very small amount of money to some company that calls itself a rating agency, and most professional investors would simply say this is crap. Yeah? I don't even read this stuff, yeah, because it's low quality. And the problem is, of course, incentive conflicts. Yeah? You only pay in order to receive a good rating. Yeah? But Moody's and Standard & Poor's, yeah, you can't buy. Yeah? Even if you pay a lot of money, yeah, you will get only a fair opinion. But this is only because they have such a large reputation, and they want to protect that reputation. Yeah? The small rating agency firms are quite often not really independent. Yeah, Continental, I think, has ratings by established rating companies. It's a bit arrogant, but I think most in the capital market, if you want to sell corporate bonds in the capital market, it's almost an obligation to have a credit rating from the 3 large rating agencies. Only few companies. There were some exceptions. Yeah? Porsche, for example, yeah? The German sports car manufacturer. It's a private firm. They are very restrictive. They don't want to share information with the public, or at least they had the tradition of not sharing any public. But for a long time, it was not even listed. Yeah? There was no stock. There was no bond. But everybody knew, yeah, that this is super solid and very low risk. Yeah? They were able to issue bonds without any rating, without providing any financials. People simply trusted them. Yeah? But this is really the rare exception. Yeah? Usually you can only issue bonds if you are very transparent and if you pay for one of the 3 large rating agencies. Yeah, and please don't forget, yeah, what we had yesterday, that the implied losses, yeah, this is not the return. This is the yield to maturity, basically. It is not the expected return. So in bankruptcy closed situations, yeah, you may say this is an exaggeration. Yeah, risk-free rate, simply because if you want to finance long-term assets, you usually need long-term finance. Yeah? You get nobody to give you only 1 year loan for a machine that lasts for 10 years. And therefore the natural reference rate is a long-term loan. Of course, the reality is large companies like Continental have both long-term, medium-term, and also some short-term loans. It's a mixture. But if you buy that firm as an acquirer, you need at least a large amount of long-term finance. And then the long-term government bond rate would be the starting point. This is market risk premium. The studies were yesterday. In the textbook it was said that this is the spread over the long-term interest rate. But in most academic studies they study the spread over the short-term interest rate. So when they say 5.5%, this is the excess return of stocks over the short-term interest rate. You must be very careful. You can have endless discussions about this. And if you are an investment banker, you want to discuss about Continental and not about this academic literature on market risk premium. So Citigroup has a very simple policy. They basically say, all over the world, in Citigroup, we all use the same market risk premium, and we don't discuss this any further. Some expert in New York has chosen this, and we just take it, full stop. And the reason is very simple. You want to make a transaction with the customer. You want to present yourself as an expert in understanding the customer, and you don't want to become a professor that teaches about the academic literature on market risk premium. It's just a waste of time. And so, Citigroup is extremely pragmatic here and basically say we don't discuss about this. And even more interesting, the market risk premium is the same for Vietnamese companies, for German companies, for American companies. Because most academics would say, no, this is not true. At least the empirical evidence says something different. There was a nice survey by Pablo Fernandez. He basically asks many professors, what do you teach your students? What is the market risk premium for Germany and what is the risk-free rate for Germany? And you see all these dots are basically single professors that answer what they recommend to their students, and you see basically lots of variation. This was 2019, when the interest rate was roughly at 0. But there was a special time, of course, because of our very special economic situation. The central bank basically reduced the interest rate to 0. Government bonds, the European Central Bank bought all the government bonds in the market. So the government bond price was going up and up, implying that the interest rates basically reached 0 or even negative territory. But many people argue this is really a very special situation and you should not calculate with 0 interest rate. When you want to explain the value of equity, it makes much more sense to have 3% and maybe a large risk premium. In the end, the DCF model is a model, and the model should be consistent with market prices. And in a situation where the interest rate is ridiculously low, you basically realize it makes more sense to use the model with a higher interest rate. It simply fits the evidence better than the observable market price. And some words on the tax tables. As far as I know, most professional bankers simply use, for example, the KPMG corporate tax tables that is available for all countries. It is in the documents that you receive, the internet link. I think similar tables exist also from PwC, probably also from Ernst & Young. But you clearly don't want to waste your time with thinking about this. But there is basically a fundamental discussion whether to use effective rates or marginal tax rates. Effective rates are those that are really paid. If you read in the you read something like this in this financial statement, yeah? Apple has earned 10 billion and their tax payment on earnings has been only $100,000. Yeah? This is close to zero. Yeah? And what does it show to you? Apple is not paying taxes. Yeah? And you ask yourself, why is this so? Yeah? And then you read more carefully and you realize, oh, there were lots of tricks how you can prevent paying taxes. Yeah? For example, there were tax havens, yeah? And you basically make sure that all the profit is allocated to tax havens. Yeah? And in Europe, for example, there was Ireland, yeah? A country close to Great Britain. Yeah? They have almost no taxation for corporate profits, yeah? And then all the Google or Apple profits basically accrue in Ireland, and they are not taxed there. Yeah? And then people say, yeah, Apple is a company that does not pay taxes. Yeah, shouldn't we put a zero as a tax rate in there? Yeah? And the professor's answer is, of course you can prevent paying taxes, but not indefinitely. Yeah? At some point of time you want to take the money out of Ireland, yeah, and pay it out as a dividend. Yeah? At that point of time it has to cross the United States and it will be taxed. Yeah? So this is basically only a tax credit, basically. Yeah? You may pay your taxes later, yeah? But as soon as you want to pay it out as a dividend, yeah, it will be taxed in the home country. And therefore, most people say the marginal or the legal tax rates. Yeah? That is relevant. Yeah? So this 20 or 20-something%, yeah, that most countries use. And yeah, and that is basically the industry standard. Yeah, nobody would even think about this. Yeah. Of course, if you were Apple, and basically you can pay taxes 10 years afterwards, yeah, but no more, then of course there was something like an advantage for this. Yeah. And maybe when you buy Apple, yeah, you not only value the assets, but you also value the present value of these tax advantages, yeah, from paying later. Yeah. But honestly, it will be only small. Even if it's large sums, but it may not be a very important asset. Yeah, and then we come to something that is really nasty in reality, and the so-called equity bridge, or on the, let's go back. Here it was called, yeah, if you go from firm value to equity value, yeah, they call it firm value adjustments here. Yeah, basically this is, yeah, the correction for net debt, but in reality, okay. So the textbook tells us, yeah, debt minus cash is basically the difference between equity value and firm value. Yeah? But then you look on the balance sheet and you see many things, yeah, where you don't know, is this debt or equity or something else? Yeah? And then you have to treat this. Yeah? And sometimes this debt equity bridge becomes much stronger, yeah? Because there were additional adjustments quite often for leasing, for example. Yeah? Leasing is something like debt. Yeah? You could buy your computer and pay interest rate on it, or you can lease your computer and then pay the leasing rates. For the valuation of the companies, quite often investment bankers say, I want to make everything comparable, yeah? So I assume that everything is financed with debt, yeah? Leasing is treated like debt. Yeah? And then I basically add the leasing, I treat the leasing as debt, yeah? And I add a liability. And to the debt. And for all these other things, I think for Continental, fortunately this is not very important, and it really goes into the nitty-gritty details of accounting. In practical terms, you basically look at the balance sheet, look for important things, yeah, that you need to investigate, and then you really have to understand the accounting meaning and interpretation of this, and you should ask a textbook or ChatGPT on what makes sense, how to treat this. I give you just the economic intuition of what your target is. Yeah? Basically, besides that, you have other things that you should add, and this is all the non-operating assets and liabilities. Non-operating means it's not in the well, let's start with non-operating assets, for example. If you have some real estate or a patent that is not part of your company, you don't need it for production. And this is like cash. It's just an extra asset that you also buy when you buy the firm. But its value is not recognized in the DCF. With the DCF, you basically buy the profits from producing Tesla cars, or the profits from producing Continental tires. When you buy the firm, you also get the cash and some patent and some real estate on top. So you basically calculate the firm value such that you pay the free cash flow value plus the extra assets. Non-operating liabilities are, of course, if you buy the firm, you may have liabilities that you have to pay, but that are not in the operations. So you have to pay salaries, that's a part of your operating profit. So the salaries are basically paid. But then you also have to pay pensions, and you realize the pensions are not yet in our cost of goods sold. Then of course you know that there is something more. It's like that, that you have to pay in excess, and you would calculate the present value of this and treat it like that. But if the pensions are only accounted in the salaries, if basically in the EBIT, of course, in your cash flow, when you derive the free cash flow to the firm, you have all kinds of costs already included. If you say this is basically paying for, let's say, lawsuits. You have a lawsuit, yes, you may need to pay something. If you pay for lawsuits every year, because you have many lawsuits every year, and in the cost of goods sold, you have included an average lawsuit, and you say this is enough in normal years, then it's already covered. But if you look into the earnings statement, and there was no item for lawsuits, because in the past there was no lawsuit. But you read in the balance sheet, there was one big lawsuit, and you may have to pay 10 billion if you lose this lawsuit. And of course this is like an extra liability that comes on top of the operations. And then it's a non-operating liability. And you have to think about how to value this. And then it would come here, coming on top of it. NCI, non-controlling interest, is something that is often confusing. It's called also minority interest, and we will tackle this, I think, on the. Okay, let's jump into the non-controlling interest first. So the idea is Continental has, of course, assets of Continental, but then it may have 60% shares of a subsidiary. It may be the majority owner of some other firm, and in the Continental balance sheet, you see the machines, and you see the 60% shareholdings in a subsidiary. This is Continental balance sheet unconsolidated, Continental only. But in M&A, we use the consolidated balance sheet. Yeah? And what you find here is the assets of Continental and the assets of the subsidiary. And of course, these are all assets, 100%. Yeah? Because consolidation actually means, yeah, you take all the assets and show them all on one balance sheet. Yeah? That is the principle of group consolidation. Yeah? And of course, Continental is not a single company, it's a large group of many different companies. Yeah? And when you look at their balance sheet, you usually look at the consolidated and you see all these activities, all these subsidiaries. Yeah? Same thing with the Wind Group, yeah? Which have VinFast and VinHotels and so forth. Yeah? Now, on the other side, of course, you have equity and debt, and then basically these other 40% here show up here. Yeah? And basically you can think of this is equity of Continental, this is equity of the subsidiary, 60% belongs to Continental, 40% is minority interest. Yeah? When you think, let's do it differently. Yeah. What is consolidation actually meaning? Yeah, you add two balance sheets. Here you have the Continental balance sheet, and then also you have the subsidiary balance sheet. Yeah? It has assets of the subsidiary, it has equity, it has debt. And this equity, well, 60% of the equity is this one, and 40% is what we call minority interest. Now, the consolidated balance sheet is nothing else than you add these two balance sheets together. Yeah? So you add the assets and show them here. Yeah? This basically is wiped out in consolidation because it's on both sides. Yeah? And all the rest remains. Yeah? So you have the equity of Continental, yeah, and then, let's be precise, you have the minority interest, yeah, because this is going away in the consolidation, but this stays. Yeah? And of course you have, I really hate all these pencils, yeah, they're so bad. You have debt of Continental, and you have the debt of the subsidiary. So this is where minority interests come from. Now, how do you treat this? Basically, you value all this. Yeah? You calculate the revenues, costs, and so forth. Yeah? And these are all basically the cash flows produced by all these machines. Yeah? But you know, these machines, only 60% belong to you. Yeah? 40% belongs to them. Yeah? So you have to subtract this again. Yeah? It's like something that you don't buy. Yeah? And it's very much like that. Yeah? Needs to be subtracted. And here, of course, you have to think about, yeah, do you use the market value or the discounted cash flow value, or in the worst case, the book value. Yeah? But you have to subtract something. Yeah. So, valuing this NCI, yeah, if the subsidiary is listed, you usually take the market price, but that's rarely the case. Yeah? In the worst case, you use simply book value. Yeah? You can see it in the parents' books, but book value is, of course, quite often too small because it's historical purchase price also. Yeah? You can use, of course, a model to do this, but then you spend much more time on it. Yeah? In a real M&A situation, yeah, you would value the subsidiary separately. Yeah, you would find the free cash flow, discounted cash flow value for the subsidiary, and then basically have your own estimate. Yeah, I think in Continental, if I remember correctly, this is only a very tiny element, so it is not important for you. But many corporations, of course, have this problem to a large extent. And then you need to, M&A bankers are people that basically know everything, a little bit of everything, and consolidation, how this consolidated balance sheet is actually created, and what the economic implication of all these things are that you find with the balance sheet is important. Yeah? Students quite often think that they have to learn theory and maybe some econometrics and computer and so forth. Yeah? In finance, most people suffer a lot from their non-knowledge of accounting. Yeah? Most professors find accounting boring, most students find accounting boring. Yeah? But if you are an investment banker, yeah, you have to read these reports, you have to talk to people that basically read these reports. Yeah? You talk to analysts and capital market investors that find this very important. And as an expert, of course, you should be also an expert in understanding these numbers. Quite often you're simply asked, yeah, how do you treat this particular item and why so? Yeah? And you should at least have a good explanation for this. Yeah, let's give one more example. Yeah? If you think about pension liabilities, yeah, you'll see on the balance sheet a liability that is called pension liabilities. And you look it up and basically see, yeah, our firm has an obligation to pay its former employees a pension. Yeah, very much like the workers get their salary, yeah, the pensioners get their pension. If you look into your free cash flow statement and see, oh, in the cost of goods sold, I have something like payment to pensions. Yeah, and the forecast is okay. Yeah, it's the correct amount, then of course it is in the cash flow statement. Yeah, but if it's not in there, because obviously it is not a cost of the goods sold. Yeah, in order to produce the car, you only need workers. You don't need pensioners. Yeah, so probably it's not included there. Yeah, and therefore it is missed out. Yeah, and you have to treat it like debt. Yeah, and then you have to think about to treat it like a non-operating liability, and you have to subtract this from firm value. And then the next question is, of course, how much? Yeah, if you find on the balance sheet 100 million as leasing liabilities, that is quite often not the true value. Yeah, because accounting gives you lots of freedom, yeah, to put the numbers a bit smaller or a bit bigger. Yeah, people, of course, love to have no liabilities or only small liabilities. Yeah, so every firm will misuse the accounting flexibility or freedom in order to downsize the pension liabilities. Yeah, and then a valuation expert will usually hire some pension expert, yeah, in order to investigate whether the book value is enough or whether you have to add something, yeah, because they are understated. Yeah, but clearly not your task over the weekend, yeah, but something that often occurs in a real-world situation. Right? You have a liability there, and you want to understand whether the book value is really the true value, because in the end, it could be that you pay much more. Yeah, and the same with leasing liabilities. But I keep this short here because I don't want to bother you too much. Yeah? But in the end, of course, from here, the present value of the free cash flow, yeah, you basically add all the non-operating assets, yeah, not just cash, but if you find a patent, if you find real estate that is not used, maybe some other securities, yeah, that are non-operating, you add all this. And of course, besides that, you also subtract the minority interests, as explained, and you subtract all other non-operating liabilities, like pension liabilities, leasing liabilities, everything that is not in here. Yeah? Everything that an acquirer would have to pay, but it's not, yeah, its outflows are not here in this cash flow statement. Yeah? That is the basic principle. And and then basically you have endless discussions. Yeah? The buyer, of course, says, I want a low valuation, yeah, and I want these liabilities as high as possible. Yeah, the seller will say, oh no, this should be not in there. And as an investment banker, you stand somewhere in the middle, yeah, and must basically propose something. Yeah. Then, of course, in the end, yeah, from the equity value, you want to know the implied share price, and you have to divide by the number of shares. And just use your time to see at the example of Continental what kind of concepts exist. Yeah, there is something like issued shares and outstanding shares. There are authorized shares. There is the concept of fully diluted shares. Yeah, all these number of shares is quite often provided by Bloomberg and similar things. And of course, they have been looking this up in the financial reports. It comes all from the financial report. Now, issued shares include treasury stock. And treasury stock is the stock that has been purchased by the company. Yeah, when Continental buys its own shares in the market, yeah, this is called treasury stock. Yeah, outstanding shares are usually only shares held by outside investors, yeah, so they exclude treasury shares. Yeah. Authorized shares are basically the shareholders have authorized the management to increase the capital. Yeah, the management can any day decide, yeah, we increase capital by 10%, for example, and issue new shares. Yeah, but they are not yet existing. Yeah, but they could immediately come into place, yeah, when management decides so. Yeah. Fully diluted shares means if everything is executed that can become a share. For example, management stock options. Yeah. The management has some stock options. If you would execute them, this would increase the number of shares. Yeah. Or convertible bonds. Yeah. When they are converted into shares, yeah, that would result in a share increase, yeah, and then we would have more shares. Yeah, so this is usually the biggest number. Yeah. In the worst case, basically you calculate that everything is executed and you have the maximum amount of shares, but this may not be reasonable. Yeah, this is actually from ChatGPT. I simply asked ChatGPT, yeah, what kind of numbers are there and where do I find it in the balance sheet? Yeah, so just as an idea for you. Yeah, if I don't know about this, I just ask my artificial intelligence, and amazingly, I get good information. Yeah, but if you ask ChatGPT, yeah, what should I use for my valuation? Don't expect ChatGPT to be an expert in this. Yeah, it may suggest something, yeah, but this is something that is solid knowledge. Yeah, it is simply given in all the textbooks, yeah, and you can easily ask ChatGPT for this. Yeah. But if you ask how a professional investment banker does a valuation, this is something not easily accessible in the internet, and therefore it has not been in the training set of ChatGPT. Yeah, so ChatGPT is more likely to hallucinate, yeah, when you ask for this. I jump over these things and also these textbooks. This is too much detail. Let's go to the last and very important thing. Investment bankers tend to think that DCF is just one model out of many models, and many investment bankers believe the multiples valuation for many investors at least are even more important than the DCF. And the general idea is, of course, DCF is a black box with lots of unknowns. Yeah, when 10 different students do a DCF, yeah, they come out with 10 completely different results, and you simply don't know which is the correct one, one is adequate. If Goldman Sachs or Morgan Stanley do a DCF analysis, yeah, maybe you trust them more because you know they are experts. Yeah, so when you are a private equity fund, of course, yeah, you hire experts, yeah, to do a real fundamental valuation, and you trust these experts. Yeah, and these experts really will basically investigate thoroughly, yeah, all the products, machines, and so forth, yeah, and will come up with their own opinion. Yeah. But that's of course only possible if you pay a lot of money, and only done when you plan to buy a firm. Yeah. So when you think about Continental, well, it's just a traded firm, and if you think, is it cheap or expensive, yeah, then the DCF that you do will probably not, yeah, you will not trust your own DCF analysis. and you will not trust other people's DCF analysis simply because you are not deep enough into it. So for you over the weekend, it's a nice try to try it out. But I think as an investor, you would usually also look at multiples valuation, simply because they are much more easy to understand. And they are basically there to identify relative undervaluation. So you look at Continental and compare Continental with other similar firms. And then you look at different ratios and you say, relative to other firms in the same industry, Continental looks a bit cheap or a bit expensive when you look at particular ratios. So let's see how this works in reality. So here we have 3 comparable firms called ABC, and we have 3 different multiples to look at. One common multiple is debt and equity over EBITDA. So the market value of the firm is a multiple of EBITDA. That's what private equity companies quite often look for. They say EBITDA is the profit that is produced for debt and equity, which is the cash flow that can be, or the profit that leads to the cash flows to be distributed. From EBITDA, you just have to add CapEx and changes in net working capital, and then you are at the free cash flow. EBITDA is easily available. You can just look it up in the financial statements, and then it should be in a relation with this value. So the companies have 5.57 or 6.4, and then the average 6.3. So you basically say, in this industry, it looks like firms are trading at 6.3 times EBITDA. That is the market value of debt plus equity, the market value of the firm. But it actually changes between 5.5 and 7. And you can do the same thing over sales. Sometimes, if you would find that EBITDA is negative, because you're looking at startup firms, if you multiply a negative number with 10 or with 7, it will stay negative. So the implied firm value is negative. That doesn't make any sense. Companies with negative EBITDA cannot be valued with this, because simply you know that stock prices are always positive, but EBITDA, if it's negative, implies a negative stock price. So firms with negative earnings or with negative EBITDA cannot be valued with this, and then you quite often resort to sales. Because sales are always positive. It's not that you really think that a company with more sales is always more valuable. In the end, of course, you pay a large stock price because you hope to receive profits in the future. The company is still making losses, even the EBITDA is negative. But of course, a company that is bigger, has more sales, is more likely to be successful in the future. And then the idea is, let's take this multiple if nothing else works, and you see the multiples also are in some area. And then this is, of course, the most traditional thing. Most people basically say the net income, that is basically what I earn if I own the equity, and this should stand in relation to the equity. So when you buy an apartment, and you pay 100,000 euro for this apartment, and the earnings are 10,000 euro every year, then you basically say, okay, I pay 10 times the earnings, and 10 times the earnings, and of course nothing else, then my apartment gives me 10% return on equity. And very simple, you pay 1 million to buy a house, you receive 100,000 euros in rental payments every year, because this is not your house, it's rented out to somebody, then the earnings is of course 100,000. The equity, here it is. sorry, no. Which I should say the net income. Let's do one more. Okay. The equity, 1 million. Yeah. And very simple, yeah, and then done by everybody every time. Yeah. You calculate to buy a house, yeah, you basically realize what would be the income. Yeah. If you have no cost and you get 100,000, then this number. Then you basically say my net income is 100,000. I pay for this house 1 million, yeah, so I get 10% is my return. If this is paid to me. And 10% return simply translates into an equity over net income ratio of 10. Here in this example, this was 18 to 24, which is more common. So basically, if you think, if you buy a stock and if you pay a stock for 100 and the dividend is 5 and the earnings is 6, yeah, then of course you could say, I buy this stock for 100. You could also say, I buy the stock for 20 times the dividend. Yeah, just implying that the dividend income is 5%. Yeah, if the dividend stays constant over time, yeah, it is like an investment that pays you 5% dividend income, yeah, or you buy this at 20 times dividend. Yeah, or you say, dividend should be a bit more. That is your 10. Yeah, quite often 50% of the earnings are paid out as dividends. Yeah, if the earnings is 10, then basically you say, yeah, I earn 10%, or I buy at a price earnings ratio of 10, yeah, and 50% of the earnings is paid out as dividends. Yeah, the other rest is retained in the firm and continues to grow the firm. And the 100, of course, is not very interesting. Yeah? If you compare 3 different firms, then you can't compare these numbers. Yeah? But you can easily compare the price-earnings ratio or the dividend-price ratio. Yeah? That makes firms much better comparable. Yeah, and now you have your firm, yeah, let's call it Z. That is the firm that you have to value. Yeah? And it has, of course, an EBITDA, a sales, and a net income. Yeah? And you use this, and you multiply with the ratios. Yeah? So, for example, sales is the easiest to calculate. Sales is an average of 1.3. Yeah? So you have to multiply the sales of 10,000 with 1.3. Oops. Implied equity value. Okay. So you multiply the sales with 1.3, giving you 13,000. So 13,000 is the firm value. Yeah? But then you have 5,000 euros of debt. Yeah? 13,000 minus 5,000 gives you 8,000 in implied equity value. Yeah? And the same with all the other ratios. Yeah? So you just use the ratios, you have the highest, the lowest, and the average ratio, calculate firm value, subtract the debt in order to find the equity value, or here with net income, of course, you just multiply the 500 with the multiplier and then get directly the implied equity value. Yeah. Now, so this high value, for example, is a high multiple of 24. if 24 is applied to 500, and then the multiple results in an equity value parity of 12,000. Yeah, and when you see, this is unfortunately giving us a huge variation. Yeah, the lowest is 4,900, the highest is 12,000, yeah, so a large interval of possible prices. And that's actually a pity. Yeah, many investors tend to believe that this is somewhat closer, yeah, because you don't need a lot of theory for this. Yeah, and when comparable firms are really comparable, well, ideally, of course, these are quite close to each other. Yeah, and these are quite close, yeah, but they vary quite a lot. Yeah, and ideally, all three multiples should have the similar results, yeah, but they have different results in reality. Yeah, and therefore, multiple valuation does not really help you to get a precise estimate of the value. You still have to think, is company A, B, or C the most comparable firm? Yeah? It cannot be that they are all comparable. Yeah? And you need to know what multiple does the market actually use. Yeah? If you see this here as if you believe that this is true, yeah, then of course you can always say, yeah, P is something times EBITDA or earnings, yeah, or this price times the number of shares plus the debt, yeah, that is of course the value of debt and equity. You can always say this is sometimes like EBITDA. Yeah, and you can solve for this question mark and basically say, yeah, this number gives me the precise value. Yeah, but you don't know what the question mark is. Yeah? If you know the value, of course, you can basically always tell. Yeah? This is the implied multiple, yeah? But it may be somewhere in this range. Yeah? So multiple valuations is very popular, yeah? Nonetheless, sometimes not really helpful. Yeah? But investment bankers don't want a precise value. Yeah? They want to basically say, the seller, oh, please sell the firm, yeah, look at this number, yeah, maybe your company is not worth a lot, yeah, you should be happy to get the price. Yeah, and to the buyer, yeah, we will point to this number and say, yeah, look, maybe the company is worth 12,000, yeah, so it's worth paying the price, yeah, and you become a happy acquirer. Yeah, this is what investment bankers want to do. Yeah, they want to make both seller and acquirer happy, yeah, and that's why they want to give evidence for both to have the numbers that they need. Yeah, this is again from Citigroup. Yeah, so our guest speakers, when they came to my class and basically showed how they value HelloFresh. And and what they actually showed with the slide is that HelloFresh could be similar. Well, HelloFresh is a kind of difficult company. There is no direct comparable firm in the market, yeah, because it is e-commerce, it is food, it is logistics, and therefore it is difficult to say. And therefore they said, look, a food delivery firm, yeah, has these kinds of multiples and HelloFresh has these kinds of multiples. Yeah? And look how similar they are. Yeah? This is 10, this is 10, this is similar, this is rather similar. Yeah, it is a similar pattern. Yeah? And from comparing the firm with an average food delivery firm, with an average e-commerce firm, yeah, you see, you basically get an impression on how the capital market sees HelloFresh. Yeah? And suppose that the blue here and the green are really very similar and all the others are very different, then you would say the capital market looks at HelloFresh as a food delivery firm. Yeah? Now, unfortunately, nothing is really similar. Yeah? There are substantial differences. Yeah? I think food delivery is still the closest. Yeah? Here, this is this is really the forward. The firm value over sales is very different. Retail again is very, very different. Yeah, they have completely different values. Yeah? So the investment bankers basically use this kind of analysis to understand what are comparable firms or what are comparable industries for a firm that is somewhat difficult basically to estimate. And investment bankers basically say, if we want to sell this firm, we have, in the first sentence, we have to explain, what is this? Is this an e-commerce firm? Is this a food delivery firm? Yeah, is this a retail firm? Yeah, because this basically shapes the perception of the investors. Yeah, if you say, I'm selling a food delivery firm, then basically the investors will look, is this really a food delivery firm, and how does it compare with other food delivery firms? Yeah, and the result of this was basically the recognition that it's very difficult to value HelloFresh with comparables, because none of these comparable industries is really similar. Then there was another thing. Citigroup then basically looks at all these industries, retail, consumer, food delivery, lists a number of firms, and for every of these firms they have basically all the operational margins and also the multiples. And then you can basically go in a rather detailed way through this in order to see where HelloFresh looks strong or weak. It looks as if it would be have a high value or small value. And ideally, of course, in all these firms here, you find somebody who is really comparable to HelloFresh. I think in the end, when investment bankers they would search for really comparable firms, because they think that similar firms should also have a similar value by the capital markets. And if they find something really similar, then they say, please compare these two firms. This value should be similar, or given that one firm has twice the amount of earnings, it should be twice as valuable. But the market prices show another picture. This looks like relative under or overvaluation. And you see just how much time people spend on preparing these spreadsheets. It's a large time to basically generate the numbers. But these then serve as a basis for discussion. As the investment banking analyst who prepared all this discusses this with the senior expert, and they will quickly point to the numbers that are interesting. Quite often then only a few numbers are really the ones that are used for the valuation and that drive the valuation estimate. So, summing up, when you value with multiples, you first have to choose a multiple. And you often use different multiples because you don't know which one is the best one. From industry to industry, people have different preferences. In mature industries, private equity usually looks at EBITDA. And the EBITDA over firm value multiple is the most common. Shareholders quite often look at this kind of thing. They look at the price and at the earnings, or maybe at the price of the dividend. And then basically say, the company that looks good in this respect or in that respect, among comparable firms is the one which I would like to buy. So I choose on this one. When you have negative earnings, or when you have even negative EBITDA, it will only produce negative numbers, so forget this. It's simply not usable. It's not applicable. If you think about price earnings ratios, I don't go into details, but they should clearly similarity or comparability ideally is similar assets and similar leverage. And when you know that leverage is not the same, yeah, but affects the earnings ratio, the multiple, then of course you must be cautious. Comparable firms should be really comparable, really similar, and then basically both the asset and the financing side. Yeah, this suitable peer group. What are the comparable firms? Here we had multiple attempts, and the first thing we just assume it is ABC, nobody knows where they come from. Then we basically look in what industry do we search them, and then basically look at all different firms in the industry and hope, of course, that comparable firms are the ones where we really find comparability. With HelloFresh, we have, of course, all the ratios in the market, so we can compare the ratio of my firm with the firm of other firms. If you have a private firm, that is not helpful. In a private firm setting, you can only observe the comparable firms, but you can't observe the ratios of your own firm. And then you are left with only looking at the industry, at the assets, and basically say, given from what I read on the description of the firm, I think that these firms are comparable. But here you have lots of data, and then basically you can look at comparability among many different aspects. What you look for is, of course, similar cash flow characteristics. Because if you believe in the DCF model, it's basically the riskiness and the amount of cash flows that make the value of the firm. So you look for similar risk, for similar timing. A growth firm will produce cash flows only in the distant future. A mature firm has stable cash flows, starting right now. We look at expected growth rates, but you look at all other kinds of things, where you know it is important for the capital market, and similarity is a plus here. And of course, if you have a very comparable firm, but it is currently in a very special situation, for example, there's a big lawsuit or it's a post-merger integration phase, and then of course you know that this special situation basically affects the firm value of the comparable firm, but not the value of your firm. And therefore, it is not a good comparable firm. So the peer group, the choice of the peer group is quite often the thing where investment bankers spend most of the time on. And as an experienced investment banker, you basically know the peer firms very well, and you can explain to your customer where the similarities are. The customer is often a family firm, and the owner, of course, knows his firm inside out, and then you have to explain to him that you think that his firm is somewhat similar to some listed companies on the market, and of course you have to tell them where the similarities are and what the capital market is looking for. And then in the end, if you do it really professional, you have to do all kinds of adjustments and standardizations. For example, if you have a Vietnamese firm, but you compare this with an American firm, and you know that the accounting standards in Vietnam and in the United States are different. For example, leasing liabilities. In some jurisdictions are a liability on the balance sheet, in others you don't see a liability on the balance sheet. Accounting difference. And of course you need to harmonize this before you start the analysis. The year-end and financial reporting is really an interesting thing. If the world is easy, if every corporation always presents its financial statement at the end of the year. And many companies do so. The 1st of January is the new accounting year. But some companies basically have the accounting year starts on the 1st of July or on the 1st of October. And then, of course, the annual financial statements have a completely different meaning. They have overlapping time periods. Ideally, you could correct for this. And then some other stuff that is good for those. If you have questions, please. please ask. Yeah, if you just Google for what are typical multiples used in investment banking, yeah, this is a list. You can you can use all these multiples if you like, and you should, as an investment banker, of course, you should be able to argue why you present one multiple and not the other. Of course, you could do all multiples and present the results of all, but as you saw in the case of Citigroup, basically you decide on one multiple that you believe is the most relevant one. And don't forget, if you think like something like value to net income, net income can be past net income, it can be analyst forecast of future net income. It could be the analyst forecast for the income of 2024, it could be the income of 2026. Investment bankers usually try to do it on forecasts, simply they believe that the current stock price of Continental is highly affected by the forecast of this year's earnings. When management discloses a change of its, well, there was something like, do you know the term earnings guidance? This is really interesting. Okay, the so-called earnings guidance is something that you read quite often in the press about. And then the firm changed its earnings guidance. And you think, guidance, what is this? the simple translation is very simple. The management discloses its own expectation on the earnings. The management at the start of the year usually says, we expect to make earnings of maybe 100,000 or between 100 and 120,000. And this is the guidance. Most firms publish these kind of guidance, and then during the year they may realize, oh, we did better or worse than expected, we adjust our earnings guidance. And this is then something that you read in the press. When you look at Continental, management will have issued an earnings guidance, and will have issued maybe a change on this. The analysts follow this quite closely. When the analysts forecast the earnings, they usually start with the management guidance. They usually say, management expects 100,000, but we believe that they are a bit too optimistic, so our expectation is only 90,000. Or we believe the management, and we take the management guidance as our expected earnings. Please.
So for like when you read during those like earnings season, right?
Sorry, can you speak up louder?
So like normally during the company earnings seasons, right? Usually like they publish those kind of like earning consensus. Those are referring to the earning guidance or the analyst forecast.
So the so-called earnings consensus is what the average of these analyst forecasts. The so-called consensus is a very popular and often read word. And when you read the word consensus, it's only about analysts. The so-called consensus is basically the average, what different analysts predict. Of course, truly consensus means they agree on something. But again, there is a misuse of wording. The so-called analyst consensus is just the average of the expectations of different analysts. And then the question is sometimes, do you use all the analysts or do you wipe out extreme values? Quite often you have a group of analysts that are almost identical, and then you have a few that are more optimistic or pessimistic. I think historically consensus was this group that are on the same level. That this is basically the consensus, and then there were some outliers that are more optimistic or more pessimistic. But consensus is always something that you get from the analysts. And on Bloomberg, basically, you have a lot of research, and the analysts basically produce a lot of research, and among this research is, of course, the analyst forecasts, yeah, which are then summarized in these consensus things. Yeah, of course, they also do their own valuation. Yeah, they say we did also an own DCF, and our result was some share price. Yeah, but of course, your valuation should be your own valuation, and of course, ideally, you don't disagree too much with the professionals. Yeah, if a professional says we believe that Continental is over or undervalued, yeah, then you hopefully find a similar value. Yeah? But maybe you have a different opinion. That's okay. Yeah, this is a nice example that I found on the internet that basically shows you that there are many things that you can look at in order to see comparability, and that it is very easy to find a comparable firm for Alphabet, that means for Google, but almost impossible to find this for Tesla. And what you have to look at basically, there was things like beta or net debt or price to book ratio. Yeah? This is all the different characteristics, how these firms are compared. Yeah? And then green is Tesla and blue is the peer firms. Yeah? So there is a peer firm that has a market cap that is both large. Yeah? The international peer and the green Tesla is both large. Yeah? But here in that area, price to book ratio, Tesla is very high. Sorry, the peer firm is very high, but Tesla is very small. Yeah? This is a big difference. Yeah? So only this and this characteristic, the comparable firm, the peer firm is identical to Tesla, but in this area, also in that area, Tesla is completely different. Yeah? So you would conclude that in most dimensions, Tesla is a completely different firm to the other, to the international peers. And the international peers are large car producers, Toyota, Daimler, Volkswagen, right in there. Yeah? With Google, the international peers are probably Facebook and Amazon and so forth. Yeah? And you see that the green area and this blue line almost coincide. Yeah? So in all these dimensions, Google looks very similar to the other firms. Yeah? And so this gives you quite good confidence that you can easily compare Alphabet to the peer firms that are in the blue line here, but you don't believe that Tesla is comparable to the other car firms. So basically you would say Tesla cannot be valued with multiple analysis, simply because the comparable firms are completely different. Daimler and Volkswagen, they produce traditional combustion engine cars, where Tesla is electric. Tesla is going to become an expert in self-driving vehicles and robo-taxi fleets and so forth. And basically when you buy Tesla, you buy a high-tech firm, and the international peer firms are just traditional car producers, and they have completely different business models. And that's why you see these differences. Of course, you won't have time over the weekend to do such a comparison, but that's of course the idea. If you work in investment banking and you really want to impress and convince your customer, you can do this kind of thing. This is basically similar. This is just a graphical representation of this thing here. If you have such a big thing, then you can basically graphically represent this and show the differences in the numbers in this nice way. And that's why I like this a lot. And then of course you can simply try and ask ChatGPT what are the pros and cons and under what conditions is this particular ratio good or bad. This is just for 3 different multiples. I think this is copied from a textbook. I don't want to go into it at all. One thing is very clear. Price earnings is not applicable when you have negative earnings, because the implication is a negative price. By the way, when you work on tomorrow or the weekend on this case, you will have lots of questions. And in the email, I gave you the email address of George, my PhD student at Frankfurt, and you can simply ask him. He is much deeper into this than I am. Yeah? I'm a professor teaching the theory. Our Citigroup partners are the professionals that basically discuss this with the student, and George, my PhD student, is the one who also prepared this exercise, Louis Vuitton, and he basically does the grading also. Maybe I can ask him to give you a little bit of feedback, but he will usually be very cautious about this, because you produce so many data, and it will take hours to really discuss all the nitty-gritty details with you. And that often doesn't make sense, and it's not economic. But 2 years ago, when I did a similar exercise here at DTU, the only question that I got over the weekend was Sunday morning. I was in my hotel, and the student asked me, the earnings are negative. I multiply this and I get a negative share price. What shall I do? And this is a question where you don't have to ask your professor. Basically, you just learn from this. It is not applicable there. You can ask ChatGPT or Google on the internet, you will immediately find the result. Of course, you should, and I invite you really to ask George. George is a very kind person. He is from Greece, and he is extremely helpful. But when you ask him, of course, you should not ask him on page 45 on this report, or on the 10th line of the table, there was a number that I don't understand. Please explain. If you do this, then at least you should basically give a screenshot of the table, because you don't want George to open his laptop, find all the documents, load them up, go to page 40 or to table number 10, and then try to investigate what your question is. So there were questions where you think that you can just put it in an email, and just by reading the email you can quickly respond. George is a person who loves to quickly respond without basically opening files and so forth. So if you give him all the information in the email, you can expect, well, I often get a response within 2 minutes. So he's the kind of person who is online 24 hours. Whenever you write an email, I think you never sleep. At least I get immediately a response. Of course, don't expect a response if he has to work for 10 minutes or even 5 minutes on this. But these kind of quick helps. George, I need urgently just a hint, quickly. You just have to look over it, then you can say yes or no. These kinds of supports he loves to do, because then he has an impact on the students, and he doesn't have too much time on this. And all this, basically, if you have another ratio and you think it's important, but just read. You have ample material in your folders, and you have to make your own judgment in the end. And you can, of course, look in the broker reports. If you just read what analysts write about Continental, you can see immediately how they value the firm. By the way, with Continental, you have one particular aspect that is important. Continental is actually two firms. It is tire and it is car electronics. And if you have a firm that basically is made up of two firms, the first idea of every investment banker is let's value that and let's value that separately and then add it up. Because tire is a very, very stable business. You just produce tires and you sell them, and the profit margins, the growth rates, the risks are quite different. So you will most likely do an aggregate valuation, just treating all the cash flows as one. simply because in the earnings statement you don't have it separately. But as a professional, you would probably think that that these are really separate, that you, for example, need different multiples in order to value these things, because they have different characteristics. So just keep this in mind, that groups of firms, these consolidated things, if you really have this company and the subsidiary and the parent company, and they have very different assets, it may make sense to you to value this with one DCF model and this with another DCF model. And for example, use different capital costs for both areas, because you say this tire business, for example, is relatively safe, the WACC is very low, and this here is a highly risky business. Okay, then let's finish this. Did we see premiums paid already? I think not. One method that investment bankers quite often also add to this is the premiums paid on recent transaction volumes. And the idea is we observe many takeovers, and in these takeovers firms are also valued. And instead of comparing with comparable firms, we can compare our firms with recent takeovers. So very easy. If firms like Continental have been taken over in the past year and average was 10 times EBITDA, then you basically say in the takeover market, Conti is most likely to have a value of 10 times the Conti EBITDA. So you look at transaction prices, and you look at how these transactions have been valued. And the EBITDA multiple is, I think, the most common thing. And in a takeover, of course, the prices are usually higher. You pay the market price plus a premium. So in a takeover context, you have bigger values. And then, of course, you think about what are comparable transactions. The company, the industry should be similar, but also many other things, like the stake acquired. If you acquire 50 or 75%, you have more and more control, and you should usually pay higher prices for larger stakes. And premiums are cyclical, so you better use the most recent transactions, things that are already 3 years old. Usually people would say this was another time, the pricing has changed. And there was a database on Bloomberg, but I'm not sure. I think for Continental we have not included this because it would make the things too complicated. But quite often investment bankers basically have access to this database, can simply type in, I want to value Continental, and then you immediately get all the information about similar comparable transactions. You can impress your customers with lots of data, which you just copy and paste basically from the database. So it quite often looks like more work than it is, because if you have access to the data, that is easy. So it's a completely new alternative valuation. So you can do DCF, you can do multiples, and you can do recent transactions or premiums paid method. This is an example for what was it? This was for HelloFresh. This is the most recent thing. So you see, 21, 17, 15. So this is this is the precise date. I think these are all from the last year. So Citigroup uses only very recent transactions from the last year. So on January 22, this company, Gusto, in UK, has been acquired for an enterprise value of 1.7 billion. And that was 4.2 times sales. Here is enterprise value over, you have to learn so much. LTM, you know what this stands for? Well, you can always Google this. Investment bankers say LTM is last 12 months. Yeah, so this is basically from the past, the accounting numbers. So they said the price that was paid was 4.2 the last 12 months sales, and you see a lot of variation. The average here is the median of 6.4. So you would say on average 6.4 times the last 12 months sales have been paid. And then what is missing here is what, for food delivery precedents. Citigroup basically said HelloFresh is a food delivery company, and many of these food delivery companies have been acquired in the recent past, and on average 6.4 times the last 12 months sales was the payment. So they basically have chosen one multiple to present the figures there. They could have used another multiple. And what they don't write is, of course, what does it imply for HelloFresh? You would then multiply the last 12 months sales of HelloFresh with 6.4 and say this is our estimate. So just looking that here were extremely high and extremely low numbers, that actually brings us to conclude that this may not be comparable firms. These firms are very, very heterogeneous, and the whole method is highly questionable if you see such a large variety of results. And then another new thing that actually comes here to this, when somebody would acquire Continental, a private equity firm would clearly think this and this are separate companies. Maybe they try to break it up and to sell these two products separately and make a profit from this. And then we think about the so-called conglomerate discount. There was a lot of evidence that companies like Continental, that are a conglomerate, that they are made of different businesses that are more or less unrelated, that they trade at a discount. Their stock price is too low. So you just buy these firms, you cut them into two firms, sell these two firms separately, and make money from this, because the business conglomerate discount. And in order to see this, of course, you look at the Conti value in the capital market right now, and you think what would be the value of the tire business if I sell this as an isolated firm, what would be the value of the other segment if I put this in a separate firm, and you would call this break-up value for some of the products. So it is relevant for conglomerates. The firm is viewed as a portfolio of different operating units that are separately valued as if they are separate firms. And of course, they will quite often be separately sold. Many takeovers result in a piecemeal liquidation, selling the different parts separately. And the group headquarters, when you really break up the firm, the group headquarters is usually destroyed. You just fire all the people and say it's no longer needed. Or what is needed is then, of course, there were some headquarter functions here that are then put into tire and car electronics. Now you have to think about what kind of personnel you need there. And then, of course, for the different units, you can do all kinds of stock market valuations. If one of these units is already a listed subsidiary and it has minority stakes in there, you can look at the market value. But usually you have to do DCF or multiple analysis, and of course most important here is recent transactions. When you plan to sell this, you think that you sell, for example, the tire business in a takeover transaction, and you look, are there other tire companies that have been sold in the recent past, and what was the valuation in there? And if you conclude, oh yes, the tire business, there is demand for some people buy this and they pay 10 times earnings or they pay 5 times EBITDA, then this is basically your estimate for the tire business. So this is actually Continental, and again this is from Citigroup, so this is your company, but that was a very old one from 2014. So 10 years ago, our Citigroup partners already have been in our class, Continental was our company that we valued at that point of time, and the investment bankers basically showed us how they do the sum of the part analysis, and they basically said, well, rubber, yeah, is tire, and automotive is basically here the car electronics, yeah, and they said, yeah, this is what we believe to be the value, just by coincidence, it's just the same. And they said automotive is trading at 8 times EBITDA, and rubber is trading at 6.7 times EBITDA. Yeah? So they basically looked into the second report, yeah, they read the EBITDA of the rubber division and of the automotive division, and then they basically said, yeah, the firm value, yeah, made of these two different segments should be 43. Yeah? And then they have this equity bridge, yeah, cash and debt, but also pensions, also minorities, also investments, yeah, these other parts that we've discussed. And then it comes to equity value of 35, and they compare it with the current market cap 10 years ago, and they see there is almost no conglomerate discount, just 6%. Yeah, that is way too low in order to take this company over. And quite often you see a conglomerate discount of 20 or 25%, and then you would say, yes, I do it. Yeah, there is a lot of profit potential in it. Yeah, so, yeah, the company trades well. If you believe, of course, you must believe in this valuation. Yeah, and then you can conclude this is the true value, how it should be, and the company is trading at a 6.3% discount. Yeah, so you may say, maybe this is wrong, and I'm not so sure. Yeah, but if you are sure, yeah, you would say, by buying the firm and selling the two parts separately, yeah, you should be able to make 6.3% when it's way too low. Yeah, this is not, transaction costs are so high, yeah, the premium that you have to pay in order to buy the firm is so high, it would completely eat up your profit potential. Yeah, but this is basically how corporate valuers analyze firms. Yeah, when they think about, is this a good takeover target? Yeah, they basically think, how can we sell the different parts? Yeah, and what is the value compared to the value in the market today? Yeah, so that's it. That is the practically decided valuation. Yeah, and you saw lots of slides that really look more professional. Yeah, so this is the style sheet from Citigroup. Yeah. All these slides have been prepared not by experienced professionals because they've been prepared only for our class, for the M&A class, yeah, but of course based on the wisdom. Yeah. If you work in an investment bank, yeah, your work is basically doing this kind of work before, yeah, and when you get experience and when you get acquainted for this, yeah, then you will be put on a real transaction. Yeah, and then of course the other people will closely watch what you do. Yeah, but you don't become an investment banker from scratch. If you come directly from university, you still have to learn this. Yeah, but these things here have been done by students that work for 6 months at Citigroup, yeah, as a full-time intern. Full-time intern really means in Germany you start at 9 o'clock, not so much earlier, but you don't leave before midnight. Yeah. Never ever. This would be a rare exception. Yeah. And many investment bankers say this is the most wonderful job on earth. I love my job, but I find it hard to find enough time to sleep. And most of the weekends, yeah, when my boss says, yeah, on Sunday at lunchtime we are in the office, yeah, the whole team is in the office and continues to work as if it would be Monday. Yeah, so yeah, unfortunately this job is really demanding. Simply because, yeah, I then say, but M&A has those waves. Yeah? Sometimes there were many transactions, and I understand that people work hard. Yeah? But then other times there was no transaction pending. Why do you still work so hard? Yeah? And then the investment bankers tell me, well, the recessions are even worse than the boom times. Yeah? Because in order to survive, we have to pitch everywhere. Yeah? We have to try to get new contracts. Yeah? And then we basically value all kinds of companies, try to present in these companies, and try to convince them, please do an M&A transactions, please hire us as your advisors. Yeah? So having no customers sometimes is worse than having customers. and people have to work hard whatever the economic situation is. And I always find it surprising. Yeah? In Germany, we have lots of discussions about work-life balance, and many people don't want to work that hard. But if you go to investment banking, if you go to strategic consultant like McKinsey or Boston Consulting Group, this is attractive only for a small group of people, and they know that in the years that they work there, they will have almost no private life, but they will learn a lot. They have nice friends there. Basically, your team will become your family. You do the travel and eating and dining together with your team. That is basically the substitute for your private life. And of course, they celebrate a lot. Quite often they are in hotels where their customers is, and they visit investors, and of course that night they also have some pleasure time and drink very expensive champagne and have fun. It's not always work, but it's extremely time intensive. And therefore I know that you are all studying very hard and also invest a lot of time. And in Germany, there were lots of people that really do not like to work hard at all. They basically say, I try my best to have a reasonable, good university education. So I do the minimum in order to get a good university entry exam, to get a good Abitur. And then of course I need at least maybe something like a grade of 2 for my university exam in order to get a job. But I'm always more or less satisfied. I don't want to be the best one. And that's enough to get a good job, and then you work maybe only for 38 or 40 hours, and you don't have to do any overtime, and then you have a nice life and it's still interesting. But this is maybe for 70% of the people, and at least the 10% that want to go to investment banking or to strategic consultant. Also the people that want to do their own startup, they understand that at least a certain period in life, you have to concentrate fully. Also when you become a professor, by the way. PhD students are well known to sit long hours on their work, simply because they know I have 6 years after my PhD when I'm an assistant professor, and in these 6 years I need 5 A+ publications, for example, which is highly unpredictable. But all the other people that compete with me work hard. And then people basically say, okay, this 6 years will be a tough time in my life. I try my best. And one thing that the first thing that people do is their apartment is in walking distance to the office. When I see all the Vietnamese people that spend 1 or 2 hours on a bus every day, no European will do this. It's just so costly time. It's a waste of time. You can't work when you are sitting on the bus. So you make sure that the conditions are perfect. That when you are not working, you don't have to do anything else. My son was working at BCG, and I realized that he was not cooking at all. He was depending completely on home-delivered food. He was also not washing his clothes, and his mom was also not washing his clothes. He completely used services for this. So he spent a lot of money just for making sure that he doesn't spend any time on these kind of things, in order to have more time to fully concentrate on the job. But again, this is only a part of the life. If you talk to people that have been investment banking since 20 years, they still say that life is hard, that they work hard, but not as hard as in the beginning. And the same thing with McKinsey partners. It's really, these years before, these years where you can, when you are lucky, you can accelerate quickly and gain a lot. And then at the end, you become a tenured professor, or you become a partner at McKinsey or a partner at Goldman Sachs, and if you reach this, basically you have all the freedom. You can continue to work hard, but you can also stop working hard and doing something else. You will never fall deeply, because this on your CV is basically enough to get interesting employment. Yeah, but investment banking really is, and I continuously ask the people, and they continuously tell me, yeah, this is how life is. Yeah, Sunday at 1 o'clock, yeah, we go to the office, and only rarely we leave the office before midnight. That is the sad truth on investment banking. Everybody wants to do it. Yeah, so many people want to do it. Of course, you earn lots of money there. Yeah, the starting salary is already high, but if you survive for 4 years, yeah, you earn incredible amounts of money. Yeah, but the price is also high. Yeah, and investment bankers tend to select only people, yeah, that have very strong, I would say, health. Yeah? Some people simply are durable. Yeah? They don't need a lot of sleep. Yeah? They are always concentrated, yeah? and I think you also need this physical aspects. Yeah? You need to be absolutely stress resistant, for example. Yeah? When I get under pressure, yeah, I sometimes get nervous. Yeah? You must not get nervous when you're working in that area. Yeah? So over the weekend, yeah, you get a little bit of this feel and touch. Yeah, and you will realize, yeah, if you really, yeah, if you want to work for Goldman Sachs and you think, yeah, everything must be correct, everything must be perfect, yeah, you will immediately realize that 24 hours is not enough, yeah, in order to do this. Yeah, if you want to be prepared to answer every question by your boss, you can spend basically days and days and days. And in reality, of course, everybody has to make compromises. Yeah? Nobody is perfect. Nobody can work as long as he wants. Yeah? And then your task is basically to invest your time efficiently. Yeah? Very much as in the real life, yeah? You've got a large amount of materials. Yeah? And just reading through this material is already hours and hours of work. Yeah? And then you still have to think how to do it. Yeah? So the best thing is really to organize in teams, yeah? To have good teamwork, yeah? To prevent duplication of effort, yeah? And to prevent things where after an hour you say, oh, this was actually not needed. Yeah? I throw it away. Yeah? This is not what I'm going to present. It doesn't lead me anywhere. Yeah? In the end, of course, you need convincing analysis, convincing data and arguments, and it's your choice, yeah, where to start and what to do. And in the end, don't forget, this is a signaling game also. Yeah? Citigroup wants to impress people. Yeah? The task is not to do the correct valuation. Yeah? The task is to impress the customer and basically get the customer hire Citigroup, yeah, in order to become the M&A advisor on some transaction. Yeah? You want to signal competence. That's all. Yeah, and yeah, I hope you will have nice fun. Yeah, so now we have a little break. Yeah, I think you look a little bit tired, but let's have a 5-minute break. Yeah, at 12 o'clock we already start our lunch. Yeah, I think 5 minutes of a break makes sense, and then we start discussing the time case. Okay? By the way, is there any water around here?
Yes, there's a water fountain.
Oh.
You need like a container or some sort to...
There used to be 2 bottles here. Maybe I can get some downstairs. I can walk to my apartment. I would simply walk to my apartment and get a bottle.
và ghé ra mua cái gì cũng mì ăn châu để đi video ra thành là châu cũng chứ nên là tới càng đông bình thường hay đi bộ tuy nhiên mình hay đi dạo thường ra chỗ dưới xe đi xe máy
sáng thì ra đường thẳng đường như vậy còn chiều thì tự nhiên ra về.
ôi ba mẹ em làm gì ba mẹ em làm
Mới em làm thiết kế còn đây
làm cái gì ồ ghê sao không lên ký túc xá ở Sài Gòn thế đi sao quá chị
Okay, before we start, I'm curious whether and what you calculate. So, what is the takeover premium that Times is offering? I want from everybody a number, or basically no number. What is your number? To question number one. Yeah, the first question. Are you prepared to give me a number? So, do you have a number? No? Do you have a number?
49.
Sorry?
49. To 51.
Okay. This is yeah. What else? Do you have a number? So this is only question one. Do you have a number? 0.6? 10%. Okay. I love this number. Do you have a number? With the first? Okay, and you?
Yeah, in my numbers, huge lines.
Do you have a number?
Yeah, I have a number. It's like
Tell it to me.
200%.
200%? Okay. Okay. Next one, what is your number? No number. You have a number? 5%? 10%? And you? 35. Okay, that's great. So, if you have no number, that's bad. If you have an answer, a question to answer, you should be prepared to basically tell the number and defend the number. This number, and this number, and this number are very good. The others may be also very good. Maybe we have to interpret them slightly different. I will show you the solution, and both these numbers appear. Yeah, but probably the others just need a bit of interpretation, yeah, and then we can translate them. So, before we start answering such a thing, yeah, we should basically think about what are the most important numbers to know. Yeah? And the announcement was basically on March 3 in the evening. Yeah, so March 3 prices were unaffected. March 4 prices were the affected ones, and we see that at the announcement, yeah, the Time share price changed by minus $2.6, and the Warner share price went up by 2.3. Yeah, and of course, we need the amount of shares outstanding in order to calculate the market capitalization of these two firms, and then we can basically conclude. Okay, let's leave it at that point of time. Yeah, let's keep these things always in mind. Yeah, we will basically do all the calculations based on these numbers. Yeah, and if you instead use different numbers, many students basically say, as a pre-announcement price, I take another stock price maybe 2 months before the announcement, or as a post-announcement price, I take another stock price maybe 2 months later. That's also okay, but traditional wisdom in the market is, if you want to know the announcement effect, you have to look immediately before and immediately afterwards. In finance, we believe that stock markets react immediately to the news. And of course, on March 4, people may not be capable of really analyzing the case. Maybe they need more time to understand the implications. But it is basically commonplace, just to use this 1 day before, 1 day afterwards in order to start the calculations. Now, the first question, what is the over premium that the time is offering? Of course, they don't offer a cash premium. Yeah? But what would be easy is if the pre-announcement price is 45 and they offer 50, then everybody finds it easy to calculate the premium. $50 is 10% more than 45, so that would be easy to calculate. But here they offer an exchange ratio. They offer 1.6 or 0.6 times the time price. And you have to evaluate the value of the offer. And what most people would do is basically they say, this is the offer. They offer 0.465 times shares. And they have a current value as of today when they make the offer, and the share price is 109, so the offer has a value of 50. And that is 10%, 10.6% above. So you are the winner, but also this 10% is probably the same. Just think about what is the value of the offer when the offer is made. When the offer is made on March 3, nothing else than the March 3 spot price is known. But now comes the professor's answers. I think even most investment bankers would do it. If you read the press, you would read Time has made an offer for Warner and they offer a 10% premium. And this is how they would calculate it. But the nice thing is, if you think it through, at the day before the announcement, this is the share price of Time, this is the share price of Warner, this is the number of shares, this is the market cap. So overall this is 14.4 billion in market cap. And after the merger, there will be 57 million shares, the existing Time shares, plus all the Warner shares will be exchanged with this exchange ratio into 82 million new shares. And so after the merger, there will be 139 or 140 million shares outstanding. If this is, each share should be worth, if this is the value, just think, we base this on the pre-merger value, but we also take the pre-merger market cap and we divide this to the number of shares, then the new share price will be 102.92. And then you can say the Time offer is worth exchange ratio times this new share price, and that's only 47. So only 4.3%. So roughly just 5%. And the interesting thing is both alternatives sound convincing. They are both based on the market values of March 3. Here basically we say, with this exchange rate, the Warner shareholders get this piece of the overall pie. Roughly 2/3 of the corporation goes to Warner. 2/3 of the corporation, the corporation is this, 2/3 belong to Warner, and this translates then in a certain share price. So, can we please try to understand which one is the correct? Or where is a wrong assumption? Or where actually are the different assumptions? Why do we have two different results? Any ideas to answer the question? You don't have to do any research. Reading doesn't matter. You just have to look at the data and think about the assumptions behind it.
เ
I think it is unquestionable that after the merger you will have 140 million shares. Yeah, because all the water chains will be exchanged, and then this is what you get. Yeah? And then the new share price will be 102. If you just compare the new share price with the old share price, isn't that surprising? Why is the share price going down? I want to give you a very easy example. Suppose time is a value of 100 and water also has a time value of 100. This is the market cap. Yeah? So instead of 8,100 and 6,200, yeah, just assume that they're both the same. Yeah? Then of course you would assume that 50% is a fair division of the firm. Yeah? Every shareholder should get 50% of the firm. Yeah? But what happens if time shareholders get only 40 and water shareholders get 60%? Yeah? Then you would say this is not fair. Yeah? Water shareholders get a benefit, yeah? And we call this a premium. Yeah? The premium simply means you are better treated than the others. Yeah? But here we have a zero-sum game. Yeah? If you treat one better, you have to treat the other party worse. Yeah? So the time shareholders basically are treated worse. They only receive 40%, although they bring in 50% of the value. Yeah? So what? Yeah? They, after the well, before the merger, time brings in 62, and this as a percentage of 14, yeah, is a certain share. Then they would deserve to have 62, 220, over 14,400. That is the fair share for time shareholders. Yeah, they should receive this percentage in all the shares of the time one. Yeah? But what they receive is a different one. And they receive 57 million over 139.91. Yeah? And this is smaller than this one. Yeah? If you calculate it, yeah, you will realize they are treated unfairly. Yeah? So basically, as an independent firm, they have a bigger share, and if you combine them, this is really like you take money out of the time shareholders, basically say your part in the firm and the overall firm is reduced, and I give this as a nice gift to the water shareholders. And that's why the share price is expected to go down to 102. When Warner shareholders basically receive this offer, if they believe that the share price will continue to be 109, then of course this is true. But to believe that this is continuing to be 109 means that this cannot be the market value of the complete firm. Because if this is the market value of the complete firm, and if the takeover is taking place, this will be the new share price. So Warner shareholders should actually say, I compare the current value of my share. They should say, I don't get this number of shares, but the share that I get is not worth this, but only worth this. Because after the transaction, this is the new company, this is the new number of shares, and this is the implied share price. And then they would calculate only a 4.3%. So, yeah. So what do you find more convincing? Do you believe it makes sense to use this price here? Or do you believe it makes sense to use this price? Well, I see you're a bit reluctant to create your own position and defend it. I would say, if you believe that this is the market value of Time Warner after the merger, then you can only conclude that this is the share price. And the assumption is, when you add two firms, you just sum up the market cap, and then you have the market cap of the new corporation. So basically, you say the merger will not create any synergies or any value surplus. Of course, you can hope that the merger creates synergies, and then you have to add the value of the synergies. For example, you have cost synergies, and you don't need two CEOs, and you can fire one, you can save some money, and then you add something. But of course, you don't know what to add currently. But basically, in this calculation, we assume that A plus B equals A plus B. No synergies, no other value gains from the transaction. And here we basically assume that the merger will not affect the stock price. But we know we are in this kind of situation. If there is no synergy, no value added through the merger, the stock price is likely to go down, because time shareholders are treated rather badly here. So I would say, this is easy to understand. The assumption is simply no synergies. The combined value of Time Warner will just be the sum of today's market values. And under that condition, which is easy to understand and easy to state, the premium is only 4.3%. And this is a bold assumption. Because given this, it's just hard to believe why the stock price should be unchanged. And the very fact that the stock price immediately went down, not to 102, but it went down, is clear that the market seems also to see this as bad news for the Time shareholders. If you think about why does the market go down, it is probably because the shareholders understand that this kind of situation happens, that the Time shareholders simply offer too much to Warner. The Warner share of the overall pie is too large to be reasoned by today's numbers. So basically the exchange ratio, the exchange ratio should be based on a comparison of this and this. In order to treat the people fairly. And if you offer a nice premium to Warner shareholders, that's basically destroying your own rights. As long as there are no other sources of value gains visible here. And for me, the very interesting insight here is that this is such a stupid and silly and easy question. You just need a couple of numbers, and most investment bankers would probably just naively say this is the premium, because they don't think further. And they are not aware of the fact that they have to add something here on the value, only if the transaction creates an extra value, such that the stock price goes from 102 to 109. So that's roughly 7%, or 6% roughly. It's roughly 6%. Must be basically added yeah, in terms of synergy gains or something, yeah, in order to reasonably assume that the stock market price will stay at 109. And this must be the assumption when you believe that a 10% premium is offered. Let's think what synergies are needed in order to justify the premium. And the answer is very simple. Think, what do you have to add here? Synergies are basically an extra value added. Synergies means, if you add A plus B, you get A plus B plus the synergies. That is the value. And synergies means less costs or more revenues, more value. And of course, if you ask the question, what synergies are needed to justify the premium? So the premium is basically time is offering this nice exchange ratio. And this is very generous, because Warner shareholders are treated very nicely. What synergies are needed to justify this? I would translate this into the answer, when would you receive a stock price of 109? Because for time shareholders, they don't want their stock price to go down. At least they want to make something. The worst case is really they do not benefit at all. So if the synergies are such that the stock price stays at 109, then you would say this is the minimum amount that you have to add in order to make this attractive for time shareholders. You could also say Warner shareholders get 10%, so time shareholders should also get 10%. We want their share price to go up. But in my calculation, I actually basically, I basically guess the correct solution. Quite often it is easier to explain when you already know the solution. So just guess that 868 million are the synergies. Now the problem is worse. The market cap plus these synergies is about 50. This is the sum of the market cap of time and water. And if you add these synergies, the company would worth 15.28. And now you calculate the share price. You divide by the number of shares after the merger. When all the mergers are exchanged, and you see exactly the same share price as today. So 109.125 is precisely the share price that we have today. So the correct analysis is what you have to add on top in terms of synergies, such that the share price is unaffected. So our conclusion is the value of time shares would not change if synergies of 868 million are, or let's say more precisely, if the market expects these synergies. The market values Time Warner and basically has to think about what are the likely synergies. If the market expects synergies of 868, then the resulting share price of Time would be unchanged 109. And of course, if the market should expect more synergies, then the time share would go up. And it is really attractive for time shareholders. If the market expects less synergies, the transaction destroys value and the time share price would go down. Now, if you think what happened, the time share price from 109 went down to 106. It did not go down to 103. So you can basically calculate from this what the market considers to be the synergies. The market values this at 106, and basically you have to ask, what do I have to add here such that $106 is the new share price? And that's the answer to the third question. So what synergies does the market expect? Yeah, this is if there would be no synergies, if you just add the companies. After announcement, the market values these share prices. Yeah, 106 was the, and 48 were the March 4 share prices. Yeah, so 14.6 was the market value after announcement. Yeah, so from 14.4 to 14.6, yeah, it was 273 million. Yeah, but the combined market value was increasing. Yeah, so it seems that the market expects synergies in this, on this level. Yeah, less than the 868. Yeah, with 868, we would have seen the timeshare unaffected. Yeah, but now we see the timeshares going down. Yeah, and this is our interpretation. Yeah, and you see a bit, yeah, did any of you do this kind of calculations? A little bit?
This one we remember, and initially the part whereby I confused was like from the stockholder point of view and the market point of view. I didn't know what is the number to plug in from
yeah. Of course, many students always ask me, how can we learn this? Is there a textbook that just gives us the right receipt? Yeah? Yeah? But for a good reason, in the United States they use these case studies. Yeah? Because in the end, every case is different, and what you have to learn is how to think into the right direction. And I think it's no surprise. Yeah? Also in Frankfurt, when I teach this case to my M&A students, many students would first think in completely different directions. Yeah? But after looking at this case solution, I think you all agree that it makes sense to approach the case this way. Yeah? And in the end, investment bankers simply have a different mindset, a different way of thinking to approach these problems. Yeah? And you can only train this by exercising it. Yeah? And I think no cookbook receipt will help. Yeah? Even if you learn 10 different cases, yeah, like the exercises, and you try to understand the theory behind it, it will still not help you to solve the 13th or the next case. Yeah, so better try to yeah, it's not the mathematics that is complicated here. Yeah? It's really to think about the underlying assumptions. Yeah? And of course, as an investment banker, you basically always think from a valuation perspective. Yeah? What is the value today? What is the value tomorrow if we add some synergies, and what would be the implied stock prices? And we have a lot of information, yeah, so we can do a lot of quick and dirty calculations. Yeah? You don't need large Excel spreadsheets to do this. Yeah? But it's still, it's not straightforward to start this analysis. And that's why I think the time case is very interesting, to open your eyes and see. I don't need to learn mathematics. I have to learn to think like investment bankers do. Okay, but now let's have a break and let's enjoy lunch. I still need to pay my lunch for yesterday.
Yeah, I'll just produce it.
So when I give you 100,000, is that the right amount approximately?